Hey there, my name's Dave. I am the Wall Street Cowboy. Thanks for stopping by. Today, I'm going to be your skipper and guide on this week's edition of The Secrets of the Trade. Today, we're going to talk about the SaVE trade, which is a trade I created some years ago. So we're going to spend about 10 or 15 minutes going over some of the basics, and then I'll do another video on another date, and we'll talk about the details of how you put one on in your account. But first, we got to make sure it's something that you'd be interested in. So sit back and enjoy the ride. Just a little history on the SaVE trade while you read the disclosure. This is for educational purposes. The history on the SaVE trade goes all the way back to August of 2015. Those of us that were trading back then remember that we had a pretty significant correction during that month, about halfway through. At the time, I was a prop trader. I had on a series of income trades, but I did not have any type of protection against a sudden correction. So after that, I needed to come up with something that would give me protection against a correction. But I wanted it to be self-funding. I didn't want to pay a lot of money for it, and I didn't want it to be a type of insurance policy that you put money in and there's really no return unless you have an event. So I wanted a trade that would give me protection and income at the same time. So the characteristics of this trade is that it does in fact give monthly income, and it does at the same time have protection against a sudden correction or even a crash, something better than 10% in 1 week or 1 month. But I also wanted it to be easy to maintain. So this is what I came up with. So let's get into the trade and I'll tell you a little bit about what it's all about. So the first thing we got to see is if this trade is for me. There are some terms that I'm going to use today that if they're unfamiliar to you, you're probably not ready for this kind of a trade. It's an advanced trade. It's for someone that has portfolio margin. If you don't know what portfolio margin is, it's a very advanced version of margin for very large accounts, usually over $100,000 in value. A risk profile is a way that we evaluate or analyze a trade graphically. If that's a term that's unfamiliar to you, you're going to have some trouble keeping up. If you're not familiar with debit or credit spreads, then this is really going to be tough for you. And implied volatility, if that just sounds like some kind of newfangled disease, then this is not the right trade for you. We're going to talk about intrinsic and extrinsic value, bid and ask spread. We're going to talk about what a diagonal spread is. Some of you may know what a vertical spread is or a calendar spread. A diagonal is a cross between both of those. It's diagonalized because it's both a vertical and a calendar spread. Portfolio hedging is what this is all about. And a T+0 line is something that you may or may not be familiar with. There are other names for it, a gamma line and some other things. And if option Greeks and all the rest of this is all Greek to you, then this is probably a little bit advanced for you. This is what the SaVE trade looks like, and this is a risk profile. It shows what the risk and reward is on a trade like the SaVE trade. This type of risk profile shows me what my potential income is from the trade and also what the potential gain would be or reward if we had a sudden crash. So let's go over what the basics are of a SaVE trade. It's often referred to as a put ratio back spread, except that with my trade I diagonalize it. Now, a put ratio back spread is when an option trader writes or sells a number of put options. You could do this on the call side. You could be selling calls too, but let's just keep it simple. He or she sells a number of put options that are way out of the money and then uses that credit received to buy more put options that are even further out of the money on the same underlying stock. And that's what gives that big sweeping upward trending line on the left side of this risk profile graphic here. So let me try to simplify that. Let's say that I sold 10 puts and I got $1 for each one. And I brought in $10 from those. And then I used that $10 and I bought 15 puts. They would be further out of the money. That would make them less expensive. And let's say that I paid 50 cents for those. 50 cents times 15 is about, what, $7.50. So I brought in $10 and I only spent $7.50 to buy the puts. So I have a net credit of $2.50. So that's where typically the premium that's brought in from the credit side offsets or entirely covers the cost of the long puts that are further out of the money. And in this particular case, this is usually for a market bias that is bullish. Okay, so let's drill down to more of the details of what a SaVE trade is. Now, in the picture right there, you're seeing a rocket take off from Cape Canaveral. The rocket is the Saturn V rocket that was part of the Saturn program on the initial attempt to put somebody on the moon. Now, the Saturn V rocket was a multi-stage rocket. It had several very large fuel cells that were used to propel a much smaller object, in this case a lunar module, up into space. And as the fuel cells were emptied and no longer necessary, they would drop off and fall back to the Earth. And then at the end, all you had was a very small payload. Well, that's what this trade is all about. We're going to put on a trade that's a very massive structure. And then slowly, we're going to take pieces off of this. We're going to let them drop off as we don't need them anymore. And we're going to collect the income from that as time goes on. And then at the end of this trade, all you're going to be left with is a couple of very nice puts that you own that didn't end up costing anything because the credit that you received paid for them entirely. But they're very small, but very effective. So that's where it got its name. SaVE is short for Saturn V. Now this is a trade that gives monthly income. It has a very high success rate, usually in the 70 to 90% success rate. In other words, I make money 70 to 90% of the time if I follow my trading plan on this trade. You can have much less success. You could have much better success. You could get up to 95, 98% depending on how you structure this. But the way that I explain it and the way that I trade it, I generally get between 70 and 90% success from one year to the next. Your results will vary. It has a tail risk hedge for a Black Swan event, and that's what that big sweeping upward trending line was on the left side of that previous graphic. It gives a hedge that gets better and better and better the worse and the worse things get. Now, you do need a fairly large account, and you're going to have to allocate about $25,000 of your margin for this particular trade. Now, we're never going to risk $25,000, and I'll get into that in a little bit, but you're going to have $25,000 of your minimum $100,000 account that is set aside for each tranche. Now, a tranche we'll get into, but a tranche is one unit, if you will, of this trade. You could have multiple units. If your account was, say, $1 million, you might want to have 4 or 5 units or tranches. But you're going to need $25,000 of margin for each one of those tranches. Now, the trade will last approximately about 45 days. It can get a little longer than that. I've had them last 60 days. I've had them last less than 2 weeks if the situation is right and I take advantage of the opportunity. But for the most part, I'm going to say much better than 50% of the time, you're going to be out of this trade approximately 45 days after you get into it. Each tranche or each trade that you allocate $25,000 to, you're going to be able to potentially gain $1,000, and that's probably a little on the low side. I normally get better than that, but I want to be conservative here. You can get a potential gain of about $1,000. The max loss that I allow for my own trading is $3,000 per tranche. Now, your results will vary. You may trade this a little differently, but I only allow myself to lose up to $3,000 for each tranche, or for each $25,000 of margin that I am putting up to put on this trade. If I'm down $3,000, I go ahead and take the trade off. Now, again, that's per tranche. So let's talk about what types of an account there are and what kind of an account that you need in order to put this kind of a trade on. There are several different types of accounts. The 3 major ones are the Reg T or Regulation T account, a regular margin account, and a portfolio margin account. Now, pretty much everybody can get a Reg T account by opening a brokerage account at your favorite brokerage. Once you have some experience and you've done some trading, they'll allow you to upgrade to a margin account, which allows you to have some leverage. Then once you have some experience with margin, you can upgrade to a portfolio margin account. Now, there are some requirements on this. The minimum, I believe, is $100,000 in your account in order to qualify for portfolio margin. I think that's set up by the exchanges. Some brokers require $125,000 so that you have a little bit of buffer between the $125,000 you start with and the $100,000 minimum. But you must have at least a 6-figure account in order for you to have portfolio margin. You cannot have portfolio margin with a $50,000 account, and you cannot have portfolio margin with an IRA account. However, there is something called SPAN, S-P-A-N as in Nancy. SPAN is a type of margin that is available to futures traders. We're not going to get into that today, but it is available, and you can do this trade in a SPAN account. Not all brokers will allow you to use SPAN in an IRA account. There are some that do. You'll have to check in with your particular broker to see if they offer SPAN and you're trying to do this in your IRA account. But it is possible to be done. Now, there are different types of account purposes. You could have an account that's just set up for hedging. You could have an account that's just set up for income, or you could have an account that's set up for swing trading and intraday trading. Now, what type of an account do you need to do the SaVE trade? You need a portfolio margin account. You may not do this in a Reg T account, and you could do this in a margin account, but you'd have to have a pretty large account. You'd probably have to have somewhere in excess of $1 million in a margin account. So if you did have $1 million, chances are you would already have upgraded to a portfolio margin account. So for all practical purposes, you would have to have a portfolio margin account. This is for hedging, it is for income, and it is a swing trade. It is not designed for intraday trading. In other words, it isn't designed for you to get into this trade today and get out of it later on this afternoon. That's not what this trade is all about. Now, what does it give you? It gives you monthly income, gives you a 70 to 90% success rate. It does have tail risk protection against the Black Swan Event. A Black Swan Event is something that you didn't see coming. It came out of the blue. We weren't expecting it. You need to have at least $25,000 of margin available in order to put one of these tranches on. It'll last about 45 days from the day you open the trade to the day you close it. Some days, sometimes a little more, sometimes a little less. The potential gain is $1,000, and that is over about a 45-day period, and the max loss is about $3,000. So that's the SaVE trade in a nutshell. I will tell you that this is one of my very favorite trades. It's very easy to maintain. I look in on it maybe once a day. Yeah, I've gone several days without even looking at this trade. It's one of those trades that takes care of itself. It is not going to be a fast-moving trade where today you're going to be up $10,000 and tomorrow you're going to be down $20,000. That said, I will say that when the market has a bad day, when I say bad day, I mean it's a down day, and not just a few points, but a pretty significant down day of 2, maybe 3% in one day, then this trade is going to look horrible on that day. But on days that the market is up, it's just going to look like, well, we just made a few more dollars and a few more dollars. And after about 2 or 3 weeks, you're going to look in on this trade. You're going to say, hey, I'm up $500 on this trade. And then you'll come back 2 or 3 weeks later, and now you're up $1,000 or $1,200. It's just that kind of a trade. I like it a lot because it does give me protection against a catastrophic event, a Black Swan event that I don't see coming. So this is a really good trade. It's not for everyone. It is for people that are looking for a hedge, that understand risk and understand patience in the market. So that's all I got for you today. Come back and we'll go through the SaVE trade from beginning to end. I'll show you how I put it on, how I find the strikes I use, what prices I use, what the Greeks are, and all that good stuff. So again, thanks for stopping by. If you like what you saw, go ahead and hit that subscribe button. We sure appreciate you. Tell your friends and come back often. And remember, good trades.